Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Azenta Inc. quarterly report. Azenta Inc. offers a wide range of businesses and services that cater to the life sciences industry globally. The company's sample management solutions segment provides various products and services, including automated storage systems, cryogenic systems, sample tubes, consumables, instruments, and controlled rate thawing devices. Additionally, this segment offers consultation services to clients throughout their experimental design and implementation processes. The multiomics segment of Azenta Inc. focuses on genomic and other sample analysis services, which include gene sequencing, gene synthesis, and related services. These services enable the company's clients to analyze and understand complex biological data, driving innovation in the life sciences industry. With its extensive range of products and services, Azenta Inc. has established itself as a leading provider in the life sciences market. The company operates globally, with presence in key markets such as the United States, China, the United Kingdom, rest of Europe, and the Asia-Pacific. Its headquarters is located in Burlington, Massachusetts, and it was founded in 1978 under the name Brooks Automation, Inc., before changing its name to Azenta Inc. in December 2021. The significant drop in Azenta Inc. AZTA stock price by over 46.77% in the past year can be attributed to a combination of disappointing earnings reports and ongoing concerns about profitability and revenue growth. One major contributor to this decline was the Cone 2026 earnings report, where Azenta announced a wider loss per share and missed analysts' EPS forecasts. The company's management acknowledged higher costs related to quality issues, contributing to margin pressures. This resulted in an approximate 22% drop in the stock price. Furthermore, the Q4 fiscal year 2025 results showed that while revenue met Wall Street expectations, it remained flat year-over-year. However, a significant shortfall in profitability and adjusted EBITDA falling below consensus estimates led to a 24.6% tumble in the stock price. Additionally, the company reported a net loss of $15.4 million for the quarter. The persistent revenue challenges Azenta faced throughout 2025 also put continuous pressure on the stock price, contributing to a decline of over 30% during that year. These factors collectively contributed to the significant drop in Azenta's stock price, making it a challenging time for investors and shareholders. Azenta Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Azenta Inc. trades at a higher price-to-earnings ratio of 44 times, and a lower price-to-book ratio of 0.75 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 16% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has aggressively reduced its share count by more than 5% while revenue has grown, but assets and equity have declined. This suggests management may be prioritizing buybacks over reinvestment, raising questions about long-term growth prospects. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of the company's performance. On the positive side, core products such as automated stores, cryogenic systems, and consumables and instruments have contributed to revenue growth. Additionally, the multiomics segment has seen significant growth in next-generation sequencing, NGS, and gene synthesis, with both experiencing 6-7% revenue increases. Furthermore, revenue generated outside of the U.S. has increased from 36.6% to 41%. On the other hand, there are several drivers of revenue decline. The disposition of B Medical Systems business has led to a decline in revenue due to discontinued operations. The Sanger sequencing segment has also experienced a loss of cost leverage from lower North America sales volume. Moreover, the Sample Management Solutions segment has seen lower revenues in core products such as automated stores and cryogenic systems. Overall, these factors have contributed to the company's revenue growth or decline, highlighting areas where the business is performing well and those that require improvement. Net income experienced a mixed trend between 2024 and 2025. On one hand, it decreased by $1 million, indicating a decline in profitability. However, on the other hand, it increased by $1 million, suggesting an improvement in financial performance. Furthermore, net loss from continuing operations also showed a decrease, from $7.1 million to $5.2 million. The change in profit margins was also inconsistent. While gross margin decreased from 47% to 43%, indicating a decline in profitability, the Sample Management Solutions and Multiomics segments experienced significant decreases in their respective gross margins. This suggests that certain business units were more affected by the changes than others. Several factors contributed to these changes. Restructuring expenses increased significantly, which likely had an impact on net income and profit margins. Additionally, total research and development expenses rose by $2.1 million, while selling, general and administrative expenses decreased by $9.4 million. These fluctuations in expenses may have influenced the company's financial performance. The company's performance can be analyzed by examining its various segments and regions. On a positive note, the core businesses have shown strong results, as well as the Sample Management Solutions segment. Within the Multiomics segment, next-generation sequencing and gene synthesis have performed well. Additionally, international operations outside of the U.S. have also seen growth. On the other hand, certain areas have underperformed. The B-Medical Systems business has struggled, with issues mentioned on multiple pages. The semiconductor cryogenics business has also faced challenges. Furthermore, within the Multiomics segment, Sanger sequencing has not met expectations. These segments and regions will require attention to improve overall performance. Management is emphasizing the need to simplify the company's portfolio by divesting non-core businesses, such as B-Medical Systems, in order to focus on core segments like Sample Management Solutions and Multiomics. This strategic shift aims to drive revenue growth and profitability in these key areas. To achieve this goal, management plans to continue investing in research and development (R&D) resources to develop new product and service offerings. Additionally, they are prioritizing R&D expenses to fuel long-term growth and improving the company's cost structure with a focus on increasing gross margin in the future. The outlook for the company is centered around core operating results, with adjusted operating income being the primary performance metric for evaluating segment operations. Management expects revenue growth to be mainly driven by the Multiomics segment, which they believe will be a key driver of future success. In terms of strategy, management is adopting an acquisition, investment, and integration approach to accelerate internal development and time to market for life sciences solutions. This approach aims to mitigate foreign exchange risks through timely settlement and forward contracts, ensuring that the company remains competitive in a rapidly changing market. There are concerns about inventory buildup and potential supply chain disruptions in the company's operations. The data suggests that the company has been accumulating a significant amount of inventory reserves, with levels remaining steady at $1 million as of both December 31, 2025 and September 30, 2025. Furthermore, the company has made non-cancelable commitments for inventory purchases totaling $1 million as of December 31, 2025. This indicates that the company is committed to purchasing a substantial amount of inventory in the future, which could lead to supply chain disruptions if not managed properly. Additionally, the company's purchase orders for inventory total $18 million, adding to the concerns about potential supply chain issues. Overall, these figures suggest that the company may be at risk of inventory buildup and supply chain disruption, highlighting the need for careful management and planning to mitigate these risks. That concludes the financial summary for Azenta, Inc. Feel free to comment below, and I will be happy to answer them when possible.